Hey, it's Jasmine Hunter, MBA EA from Hunter Virtual Bookkeeping and Tax. I'm here to teach you how to pay yourself and report your income. So this session today is going to be just about small business owners who are taxed as a sole prop. If you are interested in booking a free consultation, please scan the QR code listed here, and I will be happy to give you have a tax advisory session with you, or do an initial consultation to bring you on as a client and helping you to restructure your business. This today is going to be for educational purposes. Since I don't know your individual business needs and your business, I'm not able to provide you with professional advice. But if you book a consultation or you book an advisory session, then I would be more than happy to be able to provide that one-on-one advice. Let's jump right in. So what are your personal goals? Personal goals are definitely going to help us play a part in how you pay yourself. So is your personal goal to be able to buy a home? Are you trying to prepare for retirement? Do you want to create generational wealth for your children and your grandchildren? As your goals change, so does how you're going to be able to pay yourself. So the benefit of having a tax planning session is that you're able to adjust how you pay yourself so that you can take advantage of whatever your goal is. What are your business goals? Are you attempting, as most business owners are, to reduce your tax liability to the very minimum that you possibly could pay? Or are you looking to grow? Do you want to leverage your business and able to borrow more funds so that you can perhaps scale or grow your business? So typically you're not able to do both of these simultaneously. So you're not going to be able to achieve both reducing your tax liability and borrow at the same time, because those two are counterproductive, right? As we are trying to reduce tax liability, your goal is to show that the business earns not as much income, it has a lot more expenses, and that then will show investors and financial institutions that your business isn't cash flowing as much, which may hurt your chances of being able to borrow against your business. So number 3, tax business structure. So there's some different tax structures. So you can be taxed as a sole proprietor, you can be taxed as an S corporation, a partnership, or a C corporation. All right. So these are the business structures. Of course, you also have an individual, and that's where the sole proprietorship is going to fall under. So under the sole proprietorship, you could be, for say, an independent contractor. Are you just getting a 1099 because you're freelancing? You're working for a company, but you're not a employee of the company. You have your own, business. You don't work from them. You're an independent contractor. Remember that your sole proprietorship is often regarded as a disregarded entity by the IRS, so it doesn't see your business as something aside from you as a person. Your business and yourself are the same entity. This also applies to single member LLCs who choose to be taxed as a sole proprietorship. So your entity is disregarded. It doesn't care about your LLC status because you have elected to be taxed at the individual level. What is an LLC? You may be asking. It's a limited liability company. It is a legal entity designation. It's not relevant for your tax purposes. This is typically going to be registered at the state level with the Secretary of State in your state, or whatever authority body that your state has for you. So that's going to vary per state. You're going to need to look into that. Okay. But LLCs are typically formed for protection, so that your personal assets can't be attacked by an outside threat or an inside threat. So, liability if something happens on your property or in your business, you do something wrong, it protects you personally and holds you apart from the business. But as far as taxes are concerned, it's talking about tax liability. And because you're claiming an income tax and self-employment taxes, that has no bearing when you're an LLC, because when you're taxed as an LLC, as a single member LLC through a sole proprietorship, all of that liability for taxes falls on you as the individual, and sometimes your spouse if you are married filing jointly. So let's jump into the details. So for instance, your sole proprietorship, you are earning income either through providing services or selling products. What you're going to do to pay yourself is take an owner's draw. So an owner's draw can be taken in two ways. You could simply transfer the money from the business account to the owner's personal account. This is going to be done because you're going to have a business income account. You're going to have a business account where all of your income is coming into. You're going to have another account for owner's equity. So as you earn income, perhaps you're just, giving yourself 50%, 30% of all income earned as owner's equity, that's eligible to be paid out to you. And then you're going to transfer from that equity account that's under the business into your own personal account for use. Okay. The second way is you could just write yourself a check from the business account to yourself personally, and then pay yourself that way. It's important to know, for the purposes of taxes, you are not an employee. Okay. As a sole proprietor, you are not an employee. No taxes are withheld on your behalf. Federal income taxes are pay as you go. So as you earn income, you should be reporting that income and paying taxes on it. That's how the IRS expects businesses to behave. There is typically going to be two taxes that you owe, both your income and your self-employment tax. And these are going to be based on the net income of your business. So your self-employment tax is about 15.3% because you're not only paying the employer's portion, but the employee portion that you would have paid when you were working as a W-2 employee for another company. Typically, the employer and the employee split those. So the employer pays half, the employee pays the other half, which is what is withdrawn from your checks each month. But since you are a sole proprietor, you have to pay the full 15.3%. Your income is determined, income tax is determined from all the income that's earned by yourself, your partner that you may be filing with, all investments, all, income earned through work, minus any deductions or credits that you claim. And this is going to be paid to both the federal IRS as well as the state if your state does collect income taxes. Having your business structured in a tax structure this way can and often does lead to a higher tax liability. So because you have to pay self-employment taxes as well as income taxes, you're going to owe more tax to the IRS. The owner, you are going to claim all of your business income personally. So you're claiming all of that income yourself that the business earns. Income limits some business owner deductions. So you may not be able to claim every deduction with this tax structure, just because of the nature of the Internal Revenue Code. There may be some things that you can't claim. This is a great thing and very advantageous for a company that has an inconsistent income, right? Perhaps you're a seasonal business and you don't really make that much during the season in which you operate, or you are really making less than about $100,000 a year. It may not be worth your while to change your taxing structure to something else. Remember that you have no filing requirement if there's no income earned or no deductions are claimed by the business. So if you're not claiming deductions and you didn't earn any income, there's no filing requirement. You don't have to even complete a Schedule C in that year. Typically, this business structure is also going to have a lower tax prep fee, as well as a tax planning fee, because you're doing it at an individual level. So you may be able to get away with a lower tax prep fee. You may be able to do it yourself if your business is very simple and your books are clean and you're meticulous with keeping up on your financials. Then you could save some money there with tax prep. These are the forms that you're going to use. You're going to be, of course, using your 1040 because this is for an individual. Your business income is going to be reported on your Schedule C. That flows through to the 1040 so that you're able to claim income taxes. So the net profit that you get from your Schedule C is then also put onto your Schedule SE, or your self-employment schedule. And then that's how you determine the amount of tax that is to be paid. If you have any questions, because I know that this was definitely a very brief overview of how to pay yourself and how the taxes work for a sole proprietor, please book a consultation. If you need advisory services, please book an advisory consultation. Those are available on my website. And if you have any business needs, I am more than happy to service you and help you to grow your business so that you are able to build that generational wealth for yourself and your family. Thank you so much. Please be sure to like, comment, and subscribe. Share this video with anybody who can benefit from it. And I'll see you here for the next business structure.